General insurance and life insurance, the difference is something more. When you join the insurance itself, they will ask you to produce the age proof, the proof of death, that is nothing but the death certificate that has to be produced to the company. The person who's insured gets the benefit in the right way as far as possible. Good morning and welcome to the session 3 in unit 5, where we are going to talk about the essential claim documents and settlement limitation in principles and practice of general insurance. Now, the claim format and the settlement is one of a very important concept that we need to understand in terms of the insurance matter. So let's go further and try to understand what is the settlement and claim process. Now, the insurance policy is taken up by the consumers to compensate them in the event of happening of an unforeseen event or an unfortunate event altogether. Insurance is taken as an emergency purpose, as a standby purpose. Insurance cannot be looked into as a month-on-month or a day-on-day payment basis. It's not a regular income factor altogether. It is only taken in the time period of emergency or exigency. Now, what is happening is that it is a hedge against unavoidable circumstances. So you are trying to create a backup for yourself in case of any untold or unforeseen emergency that is coming in front of you. So that is why we say it is a hedge against the unavoidable circumstances. Now, in general insurance, the loss is payable only on happening of some specific event. Now, in general insurance and life insurance, there is a distinctive difference which I would like to bring in. Only when there is some specific event happens, then only you will be able to claim the insurance, or else you are not going to get any benefits on day-on-day basis or monthly basis or annual basis. The general insurance says that if there is going to be a damage to a specific asset altogether, if there is going to be a damage to a particular situation altogether, then only we are going to claim that general insurance, or else we are not going to come into the insurance picture at all. Now, next thing is that if the insured does not suffer any loss, no claim is paid to him. So only in case of loss, only in case of a situation where you are going to suffer from any untold emergency which is being covered under the policy, then you are going to receive some compensation as a claim factor. Now, this premium which is being charged on a yearly basis or monthly or a semi-annual basis, and no accumulation takes place. However, the scenario is different in the case of life insurance. General insurance and life insurance, the difference is something more. Why? Because in case of general insurance, there is no accumulation happening. You are just paying up the factor in order to protect the asset altogether. In life insurance, as and when you start growing up in terms of the age factor, the insurance premium also starts going up, and over a period of time, your coverage value for life will also start increasing with the insurance factor. Now, if the insured dies during the policy period, he gets the sum assured along with the bonus accrued under that policy. Very important here. Why? Because if you try to understand the life insurance during the lifetime period of the policy, if the person who has taken insurance dies due to any unfortunate circumstances, then his family members will be compensated with the money, that is the assured money, with the bonus, in order to help his family to run a normal life. Now, if the insured survives the policy periods, he gets maturity amount accrued under this policy. Now, for example, I have taken a life insurance policy for 20 years, and with all the good wishes and blessings. I continue to live my life, with the policy for 20 years. After 20 years, I will be getting the sum assured, the maturity bonus, what has been prescribed and what has been told as per the insurance policy. Now, in the second thing, we are going to talk about the claim documents and forms and the settlement procedure. Now, the documents that are required under the maturity claim is that first thing, they will ask you for a age proof, which is very, very important, followed by if the age is not admitted. Now, why this is very, very important is that when you join the insurance itself, they will ask you to produce the age proof. That is mandatory in nature. Without the age proof, you will not be able to take up the proposal at any given point of time. So, age proof is mandatory, followed by the original policy document for cancellation. You need to bring in the original policy document for the cancellation purpose, because going forward that insurance does not hold any good. That's going to get cancelled altogether, and whatever amount that is going to be there, that's going to be given back to you as the compensation, as the maturity benefit altogether. In case the assignment is executed on separate paper, that document has to be surrendered. Suppose in case you didn't have the policy document at the time of starting, on behalf of that it's been executed on a separate paper, on a separate document, then the document has to be surrendered. The value has to be surrendered, very, very clearly stating that this is what has been done. So you have to give the original proof at the time of maturity, followed by discharge form duly executed. Now, a discharge form is something where you will write down the details and you will say that the insured person is discharged. That means he is cleared of all the dues, all the things, and he is eligible to get back his sum assured, followed by indemnity bond in the case of policy document is lost or destroyed, duly executed by the policy assurer, and a surety of financial standing. So these factors become very, very important. Suppose in case the policy document is lost or there is some problem with the policy factor altogether, and if it has not been done, so then what we have to do is that it has to be duly executed by the policy holder, stating that this is the problem in which we have gone through and these are all the challenges that we have been able to face in. So we need to give in a surety of the financial standing altogether. So all these documents that have been mentioned here have to be produced in the case of when you are going in for your maturity claim. Now, followed by the documents that are required for payment of a death claim altogether. Now, a death claim is entirely different from that of a maturity claim. In case death claim, the first thing is that an intimation of death by nominee or by the near relative. So in case of a death of a person, the person who's been nominated in the form, the nominee should inform to the insurance company about the death. So that's why we say that the intimation of death by the nominee or by the relative. Now, the proof of age if not already admitted. Now, that is very, very important, as I have told you in the previous sessions also. Now, the proof of age is very, very important. While because you are submitting the proposal document, they will definitely ask for your age at which you are admitted, you are eligible for the insurance. So always the proof of age is a mandatory process, followed by proof of death. Now, proof of death is something important because you have to prove it that the death has happened under natural circumstances and there has not been anything suspicious about the death. So it's very, very clear that the proof of death, that is nothing but the death certificate that has to be produced to the company. Now, the doctor's certificate who attended to the deceased during his last illness. We need to know that what are the statements that are going to be told by the doctor in terms of his last illness, last treatment undergone altogether, because that is very, very important for all of us to understand at this juncture that what has happened to him, why it has happened, and what are the circumstances under which the person has undergone to this death condition altogether. Followed by identity certificate from a reputable person who saw the body of the deceased when the life was insured. That means we are looking in for an evidence purpose altogether for the person, and this is basically what we call it as the witness altogether. So the witness also has to be there in terms when the person was alive. Yes, he is the person who's now not with us. Now, the second thing is that the certificate of cremation or from the burial ground would says that, yes, this person has been cremated, his last rites have been performed here. Followed by an employer certificate, if any of the deceased, if that person was employed, if the person was working in an organization, we would also require the employer certificate of that person who is no more with us. So all these documents are mandatory for all of us in terms of claiming the claim or the settlement during the time of death. Followed by the maturity benefit, which comes into picture now. Now, if the policy holder lives through the duration of the policy and becomes eligible to get the maturity value, it is called as settlement of maturity claim, which is very, very important for us to understand. So, if you have taken the policy for 15, 20, 25 years and you have lived through the years of the policy, at the end of the policy time period, automatically you become eligible for the maturity benefit here. So that is why we call it as the maturity claim altogether. As the policy holder is alive, the nomination is of no significance. Now, we don't have to talk about the nomination here because the original policy holder himself is alive, so he can directly go and claim the maturity benefit. We do not need about a nomination here. Now, followed by age is normally admitted at the stage of proposal. So, for example, if I have taken an insurance policy at the age of 25, and this policy is worth for 25 years. So at the age of 50, I will be getting my insurance, that is my maturity benefit altogether. So at that point of time, the age will be already mentioned in the insurance document that at the age of 25, I joined in. The policy is for 25 years. Right now, my age is 50, so I have lived through the policy years. I am now eligible to get my maturity claim altogether. Now, if it has not been admitted for some reason, that is my age proof has not been admitted, it is necessary to submit the age proof before the maturity claim is being done, because they'll definitely ask you in which age did you take this particular policy, how long have you lived. So we need a proof to basically to understand whether the person has undergone through the policy life completely. Followed by the claim settlement option. Now, most of the claims are paid in a single lump sum. Moment, let's say that you are eligible to get a maturity amount of say 5 lakhs or 10 lakhs, whatever is the amount, you will be paid this entire amount in a single shot. That's normally the procedure which is followed by the insurance company. Now, in case of small sum assured, this lump sum payment may be necessary for the immediate need. So it becomes, it's an immediate kind of thing for the consumer, for the insurer. So it will be taken care of it immediately. However, in case if the sum assured is large, the amount, if it is being paid in installments, it would be of a valuable need for maintenance of his family. Now, let's say that I am going to get a sum assured worth of about 5 crore rupees as a sum assured altogether. Then I would expect the insurance company, if that 5 crores can be given in the form of installments altogether, so that is of a great help to my family. So that is where I'm trying to make you understand this factor that, the options that we look into the claim settlement needs to be more flexible so that the person who's insured gets the benefit in the right way as far as possible. Now, that is why we say it is surprising to see that adequate attention is not paid in this respect in terms of the settlement of claim. That is, when I say the adequate attention, that means the flexibility, the way how the payment can be generated, what are the different optional methods. These things need to be looked in really seriously. Why? Because if these things are being taken care at the initial state, at the initial level itself, then automatically the insurer can get a better benefit altogether. Now, the other thing that we are talking about in the claim settlement option is that they are available are not as in competitive rates altogether, and therefore most of the claimants would probably not opt for it because the market rate is not providing such competitive interest rates altogether. So people do not opt in for those kind of beneficial payments on step. They always want to take the money on a lump sum basis and probably they invest it back into some other sector. Followed by the lump sum payments are most likely to be spent much faster, leaving the family without the benefit of security. So one factor I would say that in the case of the lump sum security or taking out is that money gets depleted very fast, so the family members might not get any insurance or benefit factors altogether. The family, in the absence of the breadwinner, may not have the foresight of what kind of probability of expenses or what kind of capital they need, what kind of adequate financial planning that they have to do. So in that case, what happens is that the family will be again left without no much of financial support in the long run. Many insurance companies world over are facilitating the management factor of claim by offering options to the claimant. Nowadays, most of the insurance companies across the world are trying to help the people by bringing in more attractive option, by bringing in more better investment options to the people, so that what happens is whenever that lump sum money is being generated out of a claim or out of a settlement, that could be used properly, that could be put into more effective purpose so that the family gets the benefit in the long run. With this, I come to the end of this particular session. I hope and believe that this session was of a great help and resource to you. In the upcoming sessions, we shall be speaking about arbitration and salvage value, which is a very, very important concept in the modern general insurance. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.